You're with us here on a fresh new edition of Taking Stock. This is the show where we are looking back at what has happened and what a spectacular market we've had all through the course of the last 5 trading sessions. We also will try and prepare you, as we always do, for the week which is up in front of us. Global, local, you don't have to look at anything else except the next 30 minutes to find out what you need to know to approach the markets this coming week. I'm Prashant Nair. With me, as always, my colleague Surabhi. Hi, Surabhi.
Hi, Prashant. The party is on. And that's all that we can say about this week, right? So let's quickly recap, then we'll get the views going as well. It's been a heady run, and this week at least showed no signs of this party ending. It's a completely liquidity-driven rally, and that's what sort of transpired for most parts of this week as well. Just look at the numbers. I mean, they speak for themselves. The Nifty is now less than 200 points away from its all-time highs. This was a week where the Bank Nifty took out the level of 30,000. Not just 30,000. The Bank Nifty at one point looked to be taking aim at 30,500. It has closed above the 30,400 mark. So financials have been leading from the front, but mid-caps are not far behind. I mean, traders seem to be sort of really participating in a big manner. The mid-cap index for the week was up 3%, as was the Bank Nifty. The Nifty itself was up about 1.5%. Not just the week, obviously, phenomenal end to the financial year. March itself, in terms of the month, you've got a gain of about 7.5% on the index. The Nifty Bank has doubled that gain, nearly 14% for the month gone by. And mid-caps have also had a sizzling party. Just a word on the catch-up. It's an equally spectacular catch-up that India is doing vis-a-vis the rest of the world. Look at the emerging market index. It's absolutely flat. Look at the Dow. I mean, they have their own problems with respect to the economy and the cool-off there. It's actually down for the month gone by. And look at MSCI India, 9.5%. That's the power of liquidity. That's what this month and this week has taught us. The narrative, just to quickly sort of put it in context, you've been hearing a lot of this whole consumption slowdown talk, auto sector, discretionary. None of that is showing up in stock prices beyond the auto sector because the market is simply marching away. And the overall conversations that we gathered during the course of the week, the one clear view that's emerging is that even if there's a global slowdown or a US slowdown, it will actually benefit India. It'll benefit fund flows that are coming in. And thanks to sort of the benign outlook on oil prices, Prashant, I guess that was another factor that we didn't see that rally on WTI or on Brent continue. So that perhaps only added to the sentiment.
That's a comprehensive wrap out of the factors which went behind this week. Mangalam is standing by to tell us about the stocks, the leaders, the laggards, and what really happened. Mangalam.
End of the week, end of the year, as well as the end of the month. So we'll take all of that one by one. For the week, the Nifty and the Sensex high by about 1.5%. The mid-caps and the Nifty Bank, which have been the stars of the recent rally, they outdid the Nifty by a factor of 2. So a 3% gain seen on the Nifty Bank as well as the mid-cap index. The stocks that really gained this week, we had all the financials. Remember, it's the RBI policy next week. So a lot of these financials perhaps factoring in some bit of a rate action. So Indiabulls Housing Finance high by 18%. We have Yes Bank high by about 9% as well. SBI, Bajaj Finance. Metal stocks, actually, they did a bit of a comeback in today's trading session. So Vedanta was up around 6%. What did not do too well was what did not do too well all through this month and all through the year. It was the auto stocks that did not do too well. Two-wheeler stocks. We had Eicher Motors not doing too well. We had cuts coming in on both Hero MotoCorp as well as Bajaj Auto as well. In terms of stocks that gained, it was the return of high beta from the mid-cap end of things. We saw big gains come by on GMR Infra, some corporate action, strategic partner perhaps coming in on DHFL, some reports out there. That stock surging as well. Financials doing well. Union Bank, PSU banks actually have been the leader all through this month. We have tire stocks doing well too. The stocks that did not do too well, we had Reliance Communications, beleaguered company, down about 21% this week. We had Jubilant Life Sciences, Prestige Estates as well as Max Financials down by about 4%. That was the week. About the month, the Nifty gained about 7.7%. We had a near 14% gain come by on the Nifty Bank, the PSU banks as well as the small cap index. So high beta, 21% gains on the PSU bank index as well as 12.5% gains seen on the small cap index. Defensives not doing too well. Consumption as well as IT and pharma underperforming. For the year, it's been a stellar gain. Most of it coming in the latter half. Nifty higher by about 15%. Sensex higher by about 17%. And despite the recent mid-cap rally that we've seen for FY19, the mid-cap and the small-cap indices have actually underperformed.
Mangalam, thanks very much for that. That's a comprehensive wrap-out for the week, the month and the year. And Surabhi, what would bulls give for a repeat of the week for the month gone by?
Absolutely.
And the performance continuing, right?
Oh, absolutely.
Let's just spend a minute and a half just looking ahead in terms of what could matter. And I'll get to the Indian context in a bit, but let's look at the global context to begin with. Actually, as I was walking in, there are lots of news reports which are suggesting that US and Chinese trade officials are actually working on drafting agreeable lines in terms of a trade agreement. I mean, they're actually focusing on the language. That would suggest that, a deal of some sort is closer. I mean, so far we are talking about what they agree on, not agree on, but now they are actually, I mean, these are reports, source-based reports, but they're saying that they're actually working on the language so that the US version and the Chinese version are actually the same. And like it happened, or at least, I mean, it was said that it happened, China does not walk back in what it releases to its own press and media. I mean, if that happens, I mean, it could be a big one. If tariffs go, if this trade war comes to a close, I mean, that could be a big one for global markets. Okay, let's come to the second part, which is yields. Across the board, you look at, I mean, the fixed income market in the US, the US 2-year, 5-year, 10-year, and even a longer tenures, all of these actually are set up for outside months. The Friday's close will be important. What the outside month essentially will mean is that there would be more downside across the board on all these yields, on all tenures, across the curve, basically. The US 2-year yield is now meaningfully inverted as compared to the Fed funds rate. Essentially, the 2-year is yielding less than the Fed funds rate. And this is meaningfully now, I mean, stubbornly inverted. What this would mean is it would essentially call for quick rate cuts from the Fed. I mean, we're not talking about no rate cuts or normalization. We're not talking about maybe demands for rate cuts from the Fed. You look at yields in other markets as well, Germany, Japan, Canada, UK, Australia, they're all falling and falling steadily. So, I mean, this is a situation which historically has proved to be pretty constructive for the market. Global markets have not had it very good in the week gone by or even the month which has gone by. But despite this near-term pressure, the short-term pressure that we've seen, I mean, this is a setup which has quickly come to India specifically. We've had the Nifty essentially has done about 1,000 points. I mean, almost exactly 1,000 points in the last 26 trading sessions. Right? I mean, that is absolutely euphoric, but it should also give you some, I mean, it would bring about some caution. We've not seen that so far, but I would say it should. It's been one of the longest unbroken runs from a swing low. The swing low was 10,600, back in Feb. And from that, we are at 11,600 as of today's close. So, I mean, it's been a spectacular move. As of Friday's close, the Nifty has also posted a bullish outside week, which is again an extremely bullish signal. It doesn't happen very often, but it has happened, and that by itself bodes well for the coming week. And of course, the fact that if you contrast India's performance relative to global markets this week, I mean, India is essentially singing its own tune, and it's been strong, not so strong performance relative to other markets. Surabhi.
Okay, well, that's the context. Let's get going with the view on the show then. Joining in to talk about the market and, of course, the road ahead, we have with us Nilesh Shah, Managing Director at Kotak Mahindra AMC. Nilesh, always a pleasure to talk to you, to have you on the shows. So, mood has really changed. The end of this financial year is leaving people a lot more pleased than, I guess, the beginning. The question is, do you think this party that we're in the midst of, whether this can really last? Or do you think now it's kind of nearing towards its end as we get into election day?
I think market today is willing to ignore some of these signs like auto sales drop in February, some of the commentary from consumer staples company and consumer durables company that there is deceleration in demand. They are primarily taking this call on following things. One, there has been a path of fiscal prudence in last 5 years. And when you adopt path of fiscal prudence, there will be some amount of shave off on the growth side. Second, rupee overvaluation resulted into dumping by China that pushed Indian manufacturers on the back foot. Third, there is formalization of economy happening courtesy GST and demonetization. That has put some of the small and medium enterprises to change their business model in more tax compliant basis. Apart from these three things, there are three other things which is pushing growth below its potential level. One, we have endured tight liquidity in order to control menace of inflation. Second, transmission of credit is disrupted due to PCA framework of PSU banks and ILFS default, creating most NBFCs to stop lending. The third is the high cost of credit. The real interest rates in India are about 4% for government and maybe about 10% for SME. Now, market is hoping that in the days to come, these things will change. One, the liquidity will improve as currency in circulation, which has increased because of election season, will start coming back after election. Second, the FX swap which RBI introduced this year again is a novel way to provide liquidity. So market is assuming that over next 12-18 months liquidity will be better than what it was in the past, and hence it will be supportive of growth. We have a credit policy in next week and market is pricing in series of rate cut. So there will be lower nominal as well as real interest rates over next 12-18 months compared to last 12-18 months, which will be supportive for credit and growth. Third, there is Dr. Jalan committee preparing report on transfer of reserves from RBI. Market is hoping that that transfer of reserve will be used to recapitalize PSU banks and they will be back in lending business. Some of the banks have been moved out of PCA framework. Higher credit invariably will support higher growth. So in all, market is pricing in a stable government, higher liquidity, lower real and nominal interest rates, better transmission, which will all be supportive of growth in the days to come, and hence it is willing to ignore the headlines.
Nilesh, rate cut series, you said series of rate cuts. Will we, so what are you expecting next week from the RBI?
So our expectation is about a 25 basis point rate cut with a indication towards more rate cuts in the days to come, or maybe they will surprise the market with a 50 basis point rate cut. The probability of that is very, very low.
Okay. What about a CRR cut, Nilesh? I mean, I've heard some sections talk about that as well.
I think liquidity is becoming towards normal. So it's unlikely that CRR will be cut at this point of time. A CRR is not a liquidity management tool as per the communication of RBI in the past. So we do not expect a CRR cut.
Okay, now since we're talking, the way RBI will move and what we're expecting on rates in general, it's been a stunning rally in financials, Nilesh. And whether it's sort of for big banks, whether it is corporate-facing banks, even NBFCs, even a stock like Bajaj Finance, it's all moved at lightning pace in the month of March. Now, within financials, if you were to deploy incremental money, where would it go?
I think one, to expect the kind of scorching rally we saw in the month of March to continue in April or May will be little out of place. Normally you get this kind of return on a year's holding. You're getting this kind of return in just months holding. So there will be some tapering off in the days to come. But over a longer period of time, financialization of savings is a broad theme. It will work for years to come, and hence financial services firm will continue to benefit. We are right now more overweight public sector, more overweight private sector banks, both retail as well as corporate. Though there is a little bit of tilt towards corporate focused private sector banks, we are selective in public sector banks as well as NBFCs. Clearly, financial services returns will start tapering off in the days to come, especially based on the March rally.
Nilesh, what is in these financials, what are we pricing in? I mean, I was speaking with an analyst who said that, well, it's not just FY20, but I mean, stocks are now pricing in improvement all the way into FY21. Is that so? Is there a bit of, lack of alternatives also, which is playing out here?
So there is a little bit of optical improvement in profitability of corporate-focused banks. In 2018, a few of them had declared losses. 2020, they could be collectively posting a huge number of profit. So one, there is optical profitable growth which is supporting prices. Second, market is also looking at financial services as a harbinger of growth. Normally financial services growth is twice that of GDP growth. And if GDP is going to accelerate with rate cuts, with transmission of credit, with better liquidity, and it will benefit from the path of fiscal prudence, then financial sector will be the biggest beneficiary. So there is little bit of optical higher profit growth, little bit of longer term call. Combination of that has resulted into most institutional investors remaining overweight financial sector.
So Nilesh, now that the market is practically back at all-time highs, we come back to the basic question once again, right? What to buy, how to buy, because prices have run up all over again. So what would the preferred sectoral calls be, let's say, if I talk to you about the next several months, 1 year, let's say?
So one, please be aware that there is an event risk of election. Market is pricing in a stable government. But if that expectation is not met, like in 2004, then there could be a correction. Again, election results matter on the day of election. After that, fundamentals prevail. So just be ready for the volatility which might arise if election outcome is not as per the expectations of the market. But removing that out, if we look at, clearly financial services continue to be a favored sector despite sharp rally in the month of March. Financialization of savings is happening, real interest rates are on the way down, and that combination does favor financial services. Within financial services, NBFCs is a beaten down sector, and clearly there are some NBFCs where governance issues are fairly settled, where liability franchise is fairly developed, and where there are not much worries on the asset side. And most importantly, their valuations have corrected in line with the industry over last 12 months. So this bunch of portfolio, this bunch of stocks in NBFC sector could be accumulated for outperformance over next 12 months. The second big theme which could work is related to construction and infrastructure. Here we believe the real estate sector should start bottoming out. There should be more liquidation of inventory. A combination of this creates an ecosystem where cement, materials, pipe fittings, tiles, those kind of suppliers to the real estate sector should do well going forward from here. The third segment is related to capital goods. Now we don't expect a broad-based investment revival in the short term. It's probably going to take a little bit of time. But there are pockets where we are seeing investment revival as capacity utilization has picked up. And as the election uncertainty gets over and there will be some amount of liquidity and lower rates, the capex revival can happen. There are many companies in capital goods sector where capacity is becoming a constraint. Their order book is not growing because they don't have capacity to deliver. Clearly that will support their margin and the volume expansion, and combination of that could result into a scenario where capital goods sector selectively can also outperform the market. We are more of a bottom-up stock picker right now rather than top-down, but from a thematic point of view, these are the segments: capital goods, ecosystem towards real estate, and financial services, which should do well.
It's a pleasure, Nilesh. Thank you very much for joining us here on this edition of Taking Stock. Have a fantastic weekend, and we'll see you soon. Thank you indeed. Let's quickly also look ahead in terms of the events which are lined up and which will matter to the market, both local and global. My colleague Anisha is standing by with a list of what you need to know. Anisha.
Well, it is start of a fresh week, month, quarter and the year as well. And it might be Fool's Day on April 1st, but I kid you not when I say it is going to be a very important week. First up, we will see the listing of the first ever REIT, that is the Embassy IPO, which will be listed on April 1st. And since it's April 1st, we will also be watching out for the auto sales number, which will give us deeper insights into the state of the economy. Separately on 1st, it is the last day for you to hold shares in physical form, as well as expect some transition for the GST rates on under construction property, because 1st April is the effective date for that. Other than that, we will also get the core sector data for the month of February. Remember, in the month of January, the core sector data was rather weak at a 19-month low, and it is expected that there might be some pickup in the month of February. Remember, in the first week, we'll also get the PMI data for India and a lot of global economies. For India, in the month of February, the PMI had been strong, supported by the manufacturing sector, which came in at around 53.8, and it is expected that things might pick up in the month of March as well. Other than that, the most important cue really to watch out for this week is the RBI monetary policy meeting. Now remember, it starts on 2nd and ends on 4th. Most of the economists expect that there will be a rate cut of around 25 basis points that is coming, and they're split in the middle when it comes to the change of stance, because half of them believe the RBI might change its stance to accommodative going forward. Other than that, there'll be a Metropolis IPO which opens on April 3rd, and since it's the start of the year and a fresh month, we might get some provisional data from some of the companies. So the likes of Titan, Sobha as well as BHL are known to really come out with provisional data, so watch out for any numbers being reported there. And lastly, on the global front, US-China trade talks and developments around Brexit continue to be on the radar. Back to
a sign that earnings growth is actually beginning to stabilize, and the absolute number is actually quite good. We're looking for about 16% growth in calendar year 2019.
Recovery from some of the weakness that we've seen and some of the fundamentals that have been, that have been somewhat disappointing in terms of, auto sales, commercial vehicle sales, and other economic measures which have been weak. The assumption is that that'll recover, and all of those can give us an upside of 20 to 25% in the Indian market.
I think the overall context, I think longer term for emerging markets seems to be quite positive.
I still like the IT sector. It's had a good run, it's had a nice pause, and I think it's probably ready for the next upturn going forward.
Our view primarily is that what we're seeing now is to a large extent a cyclical slowdown for the auto sector, and we would not attribute to any structural factors that one could think of.
The level of underperformance to large caps is as same as what it was in FY14. So that's the level of dramatic underperformance you see in mid caps. So we believe that there's no further downsides anymore.
Okay, welcome back. You're still with us here on Taking Stock. That's the most important opinion from markets that we got through the course of the week gone by. You heard from Nilesh Shah and the fundamental perspective. Let's get to the technicals, the charts. Ashwini Gujral is with us with his view on the technicals for the week. What do you need to know? Ashwini, thanks very much. First up, let's pick it up from where we left off on Friday. Your thoughts on the way the market traded? Absolutely euphoric, strong. What does it tell you about the coming week?
Well, overall, the uptrend continues, and the market in its tendency tends to continue once a trend starts. Financials took a day off, but my sense is even they will pick up again. Overall, 1 year of big bashing, people are underinvested and they are getting back in a hurry. So that way, portfolios are getting built, and the idea should be to stay in as much as possible. Like last year, the idea was to stay out and wait for all the carnage to happen.
Okay, all right, Ashwini. Now, what about individual stocks? What ideas for next week?
Today was the first day when metals did well. So JSPL is a buy with a stop of 175, target of 190. HPCL is a buy with a stop of 280, target of 294. And Sun TV seems to be bottoming out. This is a buy with a stop of 620, target of 645.
Okay, all right, Ashwini, thank you very much for those calls. And with that, we are out of time on this edition of Taking Stock. So Prashant and I are going to take your leave. Have a great weekend. We will see you with the markets bright and early on Monday morning in a brand new financial year.